Welcome to this edition of the debate on France24. I'm Andrea Sankey in Paris. Tonight, how secure is the state of our global markets? Now, we may have seen worse before, but recent market volatility has made many investors very nervous. Global stocks tumbled on Wednesday as the stability of the U.S. subprime lending market and other credit issues came into question, and the fallout from the collapse of two large hedge funds managed by Bear Stearns rattled nerves as well. So, does the turbulence serve as a sign of even rougher waters ahead? Or are there enough positive indicators to calm investor fears? Well, joining me tonight to debate that, to my left, Liz Alderman, business editor at the International Herald Tribune. To my right, Christopher Mesnu, international corporate attorney. And again, to my left, Max Kaiser, markets and finance analyst and founder of KarmaBank.com. Also, hopefully joining us later in the program via satellite from Lexington, Massachusetts, Nigel Galt, chief U.S. economist from Global Insight. In fact, I think we have him. Good sign. All right. I'll start in the studio, though, and let's begin with a look at the markets and assess how much should really be made of this week's jitters so far. Are there ominous signs here, Liz, or are these just your average corrections?
Well, this correction is not quite as bad as the last one we saw several months ago back in February and March. But that being said, I think what we're seeing here is a sort of a cumulative effect of concerns that have been growing about the subprime market in the United States. What seems to be a little bit different this time around is that some of the exposure that we have seen to the subprime market seems to be spreading just a little bit into some foreign markets. This morning, Macquarie Bank of Australia indicated that it had some exposure which caused significant jitters in the Asian market, which then filtered into the European market. Earlier this week, we saw a German bank as well signal some exposure to the U.S. market, which, you know, just fanned the nervousness. As to how long this current cycle of volatility will last, it'll probably blow over just a little bit. But the fundamental concerns will remain because as the subprime woes grow, it's likely that that might start to have some effect on the American economy and consumers who are homeowners. And if that cycle starts to deepen, if we see a fundamental sort of effect on the American economy, then I think a little bit later in the year you would see even increased market volatility come back to haunt us. And
ultimately leading to what, beyond just volatility?
Well, leading to possibly a slowdown in consumption in the United States as significant numbers of homeowners who are owners of these subprime mortgages find that it's increasingly difficult for them to pay back. Again, if there's a slowing in the United States economy, that affects trade with other countries. And usually when the United States sneezes, the rest of the world catches a cold.
Okay. Christopher.
I think it's been said recently that Asia has become more and more immune to the United States sneezing, but this may very well be the crisis. If it really develops into a full-blown crisis, this may actually be the scenario where we learn that Asia is not as immune to the United States catching colds, because if in fact consumption in the United States slows down, that's going to have a material impact on Asian exports. And no matter how much Asia has developed as an autonomous economic unit, it still is largely export-driven and to countries, in particular into the United States. So this could actually climb up the ladder and not stop simply at the U.S. subprime market.
Max, your take.
Transparency. That's a big issue. Bear Stearns, they've got a third hedge fund that's in trouble. They've said that people are not allowed to take money out. They're kind of engendering a panic over there. We don't know what these banks and investment banks are holding in the back areas of the bank. There's very little transparency going on. Fannie Mae and Freddie Mac supposedly have tens of billions of dollars of bad debt that they haven't marked to market yet. This is an issue of being marked to market. You hear this phrase all the time. What does it mean? It means, well, if you have a party and a counterparty making a deal, but there's no actual liquid market, they decide what the price is and not the market. Now the market's forcing these deals to be priced, and what they're finding is that they're not worth 100 cents on the dollar. They're worth 0 cents on the dollar. Just today, Moody's said they're going to have to look at these Alt-A mortgages and reprice them down anywhere between 10 to 100%. 10 to 100%. That's a complete obliteration. The damage done is pretty severe. You're talking several $1 trillion in damage. The volatility index is at historic highs. That'll indicate tremendous uncertainty out there in the marketplace. A lot of money being lost. The damage is pretty bad on some of the tertiary indexes that are not quoted, like the Dow Jones Index, are being wiped out. The finance indexes, the banks, Lehman Brothers, Goldman Sachs, Bear Stearns, their stocks are getting hammered. Going back to February, as I indicated back then. There's systematic structural difficulties.
Okay, I'd like to get back to the hedge funds that you were referring to in just a minute, but first let's get Nigel's take. Nigel, at the top, if you couldn't hear us, I was asking about just the basic assessment of what's been going on in the markets this week and how, if you see these as ominous signs, or are they just mere corrections, in your opinion?
Well, I think what's happening is that we have had this huge downturn in the U.S. housing market. It's continuing. There's no end in sight. There are billions of dollars in bad loans out there, and we're only just now finding out who is ultimately on the hook for those loans. And I suspect that there's plenty more bad news to come in the housing market area and in bad loans. What is also happening now is that on top of what's going on in the housing sector, we're getting a repricing of risk more broadly in the market. Risk spreads had been extremely low, unusually low by historical standards. We're now moving back towards much more normal levels. The more difficult question, the unknown question, is how far this will go, whether this is a welcome repricing of risk, which means that risk will be normally priced in future, or whether this deteriorates much, much further, takes us into a full-blown credit crunch, which ultimately requires intervention from the Federal Reserve.
What a grim prospects. All right. Max, you had a final word?
Well, I would agree with that assessment. There's a lot of risk that's not been accounted for. There's very little transparency. It's a huge issue. And once these dead bodies float to the surface, you're going to find huge dislocation. Yeah, the Fed might have to step in and adjust rates, but they can only control short-term rates. Remember, if the Fed comes in and lowers short-term rates, it does incredible damage to the value of the U.S. dollar. Then you have to ask yourself, well, what about U.S. creditors like China? Were they going to be incentivized to dump the dollar, which it could take the long rate higher, which then puts more of a kibosh on housing. So there's a tremendous pincer movement going on in terms of how to value these securities, and it doesn't look good.
Okay, let's take a closer look now at the hedge funds that are in question. As we said, Bear Stearns watched two of their own collapse. They've now had to stop investors from pulling out of a third. Macquarie Bank has its issues as well. What does that say to all of you, really? Are huge, unregulated hedge funds finally showing how fragile and even maybe how dangerous they can really be? Liz?
Well, it's a big debate right now, particularly in the United States, as to whether hedge funds should be increasingly regulated. We're seeing quite a lot of discussion of that in the Senate and the House of Representatives. That discussion has also started to fan over here to Europe. There are a lot of arguments actually against hedge fund regulation, which is, at least according to the hedge funds, that many of the transactions actually wind up being beneficial in the long term because they wind up ultimately creating jobs, producing efficiencies within, companies, et cetera. But I think it's truly an open question as to whether it would be beneficial if we cracked down on them.
Is it, as a financial analyst yourself, does it concern you just the mere fact that we really don't know how much is out there in hedge funds? We know it's trillions of dollars, but there really is no genuine calculations as to what's ultimately at risk.
Well, I think somebody like Max actually might be better positioned to answer that question.
Well, it's fraud. It's outright fraud. Bear Stearns is engaged in a fraudulent activity of counterfeiting paper, essentially, is what it boils down to. They sell the exact same paper that's collateralized by virtually nothing over and over again, whether it's called a collateralized debt obligation or a credit default swap. This is just basically outright fraud. It's a game of musical chairs with no chairs. When the music stops, no one's going to suck up this paper. There's no market mechanism that can possibly handle. There's $400 trillion worth of derivative paper in the world. This is a planet, Earth, with a $40 trillion economy. Who's going to suck up $400 trillion in bad paper? In other words, every quarter it just gets moves from one balance sheet to another. They book a fee, and somebody else takes the risk, and before the quarter's over, forcing them to take that as a disclosed risk, they sell to somebody else. That's outright fraud. Now, if I'm a hedge fund investor in one of these Bear Stearns funds, I'd be getting the tomahawks out, going down to Bear Stearns headquarters and demanding Jimmy Kane come out with his hands up, because this is not a matter of regulating or not regulating. This is a Ponzi scheme.
Christopher, are they that dangerous, in your opinion?
Well, I think what's potentially dangerous about these funds is so few people have real visibility about how they're operated, how they're structured, how they price, how people get in and how people come out. If you look back historically, securities started getting regulated in the United States in 1933 and 1934 after the stock market crash of 1929. The SEC was created in the early 1930s as a response to the go-go Wild West environment that existed in America through the end of the 1920s. It may very well be that historically speaking, we're coming into a cycle of re-regulation of financial markets, and that would include potentially the hedge funds, although the amounts of money involved and the relative lack of transparency is much greater than it ever was going back to the 1920s.
Okay, Nigel, let's get your take on the hedge fund issue here.
Well, the lack of transparency certainly worries me. I believe that the real message here is let the buyer beware. The people who are investing in hedge funds, buying their assets, these are grown-up investors who are taking on risks, and it's really up to them to demand the disclosure they need to fully understand the risks they're taking on. And what we're finding out now is previously they didn't fully understand those risks. Maybe there's a role for regulation, but I think the biggest role is for investors to demand the information they need to know what risks they're taking on.
But at the very least, and this might sound kind of naive to say, but it's true, high risk, high return. They might not have the lists written out, or the risks written out for them on a list, but they know how volatile these funds can be and that there is dramatically high risk.
No.
So can't they take responsibility for themselves?
Who are the biggest buyer of this toxic waste? Passive accounts, pension accounts, college endowments. Harvard just announced today that $350 million wipeout due to being sold junk, toxic debt. Remember Robert Citrone in Orange County? He's sold a bill of goods. It goes into the pension account. They had to declare bankruptcy. A lot of times, it's high-pressure sales. They just put a lot of junk into these pension accounts, these passive accounts, where it goes to die. It's a great graveyard of these packaged, structured financial products are on these pension accounts where they just left to fester and die. And the responsibility of the pension manager to overlook and oversee, there's a fiduciary responsibility, of course. But, what about the Frank Quattroni defense? You remember he got caught laddering IPOs, and his defense was, well, my crimes are so complicated, no jury can understand them, so I'm innocent. That's the kind of, that's what we're dealing with, that element.
That case,
Very well, very well. And, of course, that goes back a few years when things were, relatively speaking, simpler, and the amounts of money involved were somewhat lower than they are now. So this whole thing has really gotten beyond any one person's comprehension.
What about this idea of moral hazard, which is huge in the marketplace today? People who sell these bonds know that if they run into huge trouble, the Fed will bail them out. Long-term capital management, pure chicanery, pure fraud. They blew up a $1 trillion credit line, lost billions. What did the Fed do? Lowered interest rates. So every mom and pop out there, people on a fixed income pension account, had to have their monthly income reduced for some yacht owners in Connecticut. That's a complete miscarriage of financial justice. It's not democratic. It's not even capitalism.
Okay, Nigel, are you on the same page here?
Well, I think, to a certain extent, people have to take their lumps, have to take the losses. If something is high risk, it means that the return may be high. It also means that there's a risk of being wiped out. And I think as far as the Fed intervention is concerned, I do think we have to be very, very careful this time, because the Fed does need to, I think, make it clear that intervention is in a case if these troubles start causing systemic risks, start threatening to bring down the financial system or the whole economy, which probably was the case in LTCM, but that it's not going to step in to bail out hedge funds left and right just because of bigger losses from these mortgages.
Let's talk about something about these packages, these structured finance. We know that in the collateralized debt obligation market, the trick that's used is that they take really bad subprime debt and they mix it up with AAA rated debt, government debt, and then a rating agencies like Moody's comes along and says, well, it's an A-rated piece of paper. So I'm a pension manager. I see, well, you're selling me A-rated paper. I rely on Moody's to give it an A-rated paper. I'm putting it in my pension account. 90% of it is junk. It's CCC, toxic, fraudulent, nightmarish paper that's just printed in Bear Stearns' back office. There's no relevance to anything. And they give it a high rating of AA or AAA. Moody's is coming clean on this. This is outright, I'll say it again, this is outright fraud. And now they are quickly tap dancing their way away from what would appear to be some massive suits in the pipeline.
Okay, we shall see. Right now, though, we have to take a 12-minute break for news and weather, but we can continue this discussion, of course, after that time. I'd like to thank Nigel Galt for joining us, Chief U.S. Economist from Global Insight there in Lexington, Massachusetts. You won't be with us, unfortunately, for the second half, so thank you. But the rest of our panel returns when we come back from this break. Do stay with us.